Hey everybody, this is Ryan Malley, and we're going to do a stock market update here. If you remember from the last update that I did last week, I said, hey, the market is setting up for a very nice bullish bounce. We got that bounce this week. Small caps, IWM, Russell 2000, they were by far the strongest of all the indices. The Nasdaq, maybe a little bit less so based off its candle price action. The S&P 500 was wedged just nicely in between there. Now, we have a wrench in all of this that nobody was expecting coming into the week, but we got it. 1 o'clock early Friday morning, we got a tweet from the President of the United States stating that he was infected with the COVID-19 virus. Now, whatever you think about the guy, better or for worse, doesn't really matter about this video. What matters is the fact that we're talking about its impact on the stock market. So let's keep our focus here. And an impact it had. The stock market dropped 60 points pretty much immediately as soon as the news came out. It dropped like a rock. And it created a lot of uncertainty because you want to know something? The market hates uncertainty. It doesn't like it. So what you're going to see in the week ahead is the market very focused on the president's recovery. Is the president recovering? Because the market has done very well under his presidency. So if he gets COVID, yes, it is a major concern for the stock market. And considering his age and his health, yeah, there's some underlying factors there too to consider. So the market's going to be paying very close attention to President Trump's recovery from COVID. And Friday after the close, he went to Walter Reed Hospital, which he's going to be there for a few days. He's starting to show some symptoms. The market's probably not going to like that too. Whether or not we see an update between now and the time that the futures open up on Sunday night or the time that the regular trading hours are on Monday, who knows? But the one thing you can guarantee is that the market will be paying attention to that. So what I'd like to compare it to is the China trade war. If we go back to the China trade war, and this is what I think how it's going to play out, you're going to see the market rally and fall based on the health reports that we get. If they're good, the market's going to rally. If they're bad, the market's going to pull back. Just like the China trade war, when the news was good about a deal being reached between China and the United States, the market rallied. But when the opposite happened, the market sold off. Maybe like the trade wars, we'll see a COVID phase 1 recovery for Trump, and maybe off after that, we'll see a COVID phase 2 recovery, and then we'll go through the cycle and go right back to phase 1 and then hit phase 2 again, because that's what we saw during the trade war, and the market did quite well as a result of that. But now we have a strong dose of headline risk with the president's health that we have to pay attention to. And if things start to deteriorate with him, you can expect the price action on the stock market to deteriorate as well. But we're going to get into what you need to know on all the time frames for the S&P 500, for the Russell, and for the Nasdaq. And this time around, I'm going to focus on SPY, IWM, and QQQ, because a lot of you guys trade those directly. So let's do a market update and use those particular indices to help us with understanding the stock market in the days, weeks, and months ahead. First up, the SPY daily chart. Last week I said I really thought we were going to see a SPY bounce, and we did. We saw the SPY bounce very good. The S&P 500, the Nasdaq, and the Russell all rallied. But it was really just the Monday gap where we saw any real price movement. In fact, beyond the Monday gap, the market didn't really go anywhere because of the sell-off that we saw on Friday. The sell-off on Friday was pretty hefty, and it pulled back all the way to where the market gapped up at. Now, the price level support going all the way back to the gap down in February, that's my line in the sand for the S&P 500 and SPY. If it breaks below that, that's where I'm going to get a lot more bearish. But as long as we hold that, I will stay bullish. Now, if it pulls back closer to it, I may trim some of my holdings just because I want to make sure that I'm not overly exposed as the market's selling off. But as we get closer to breaking those Thursday highs from last week, I'll get more and more long. Or if we do test that support level going all the way back to February and we hold it and we bounce, it'll be a similar play to 2 weeks ago where the market tested it and started to bounce, and I started adding more long exposure. I'll just rinse and repeat. I also want to show you this inverse head and shoulders pattern on the SPY. You also have it with QQQ as well. On this chart, you have a nice neckline that's forming all the way back to the beginning of September. It's going all the way across, and it's forming the neckline for this IHNS pattern. If it breaks above it, which will be somewhere on the S&P 500 at around 3391 to 4,000, on SPY it'll be somewhere around 338. If it can break above that level, then the market should really make another attempt at establishing new all-time highs. So that's going to be a key level and pattern for you to be watching next week. And once that breaks, or if that breaks, I'll certainly be looking to add more long setups to my portfolio. Now back to the daily SPY, one of the things that does concern me is that following the decline off of the September highs where we saw about a 10% pullback in equities, the market bounced and then it broke that declining trend line on Monday's gap up. But it never formed a higher high. In order to have done that, it would have needed to have broken the highs from September 16th. It didn't do that. Now it has next week to try and do that, and it has the week after that to do it, barring any major sell-offs, but it needs to break it. It's not that far away, but that would be a huge deal if it can break through that level. On the SPY chart, you also have a very nice bull flag that has formed over the last 4 weeks. It snapped that 4-week losing streak, broke out of it with this week's price action, but the candle overall is not that impressive. Really don't like it. It's not trading above any of the short-term moving averages like the 5 and the 10-week moving average. It's not doing that. And if the S&P 500 does manage to continue rallying next week, you have to be aware of this huge long-term resistance level going all the way back to 2012. Every time it's touched it, it has struggled mightily with it. You can see that same pattern on the monthly chart too. Every time it's touched it, it's been faced with heavy resistance, and as a result, it's pulled back on a multi-month basis. We've already started off October on a negative note. There's plenty of time to erase that, but nonetheless, history tells us that most of the time we see 2 to 3 months of weakness in the market overall. So keep your eye on that. Don't think that we're totally out of the woods yet. We could see another 1 to 2 months of selling if history does decide to repeat itself yet again. Hey, and let me tell you real quick, I have a great new feature on my YouTube channel called YouTube channel memberships. It allows you to go above and beyond these videos that I provide every week, 2 of them a week, and it will give you access to all of my market research that I do each and every day in the stock market. You're going to get everything from market index updates with the S&P 500, the Russell, and the Nasdaq multiple times each week. You're also going to get access to my indicators, FANG stocks updates like Facebook, Amazon, Netflix, Apple, Google, Microsoft, and Tesla. And you're also going to get my personal watch list with bullish and bearish updated twice a week, as well as some of the most fascinating charts that I find in the stock market each and every day. So make sure to check down below, click the join button, and I'm sure you'll like what you find. Getting back to QQQ here. Inverse head and shoulders pattern on the daily chart, just like I talked about on the SPY chart, a little bit more pronounced on the daily chart than what we saw on SPY. It could be forming the right shoulder of that pattern, and if it does, it needs to break Thursday's highs and we're back to all-time highs again. But besides that, the price action from the last 3 days, it almost has like a more of a bearish island gap reversal where you gap higher and then you gap right back lower, and that's never a good sign. It creates a little bit more uncertainty. Oftentimes it can be mark a short-term top in a rising uptrend, and that's what we may have right here. But what I don't like is the fact that on the daily chart we closed at the week's lows. It was like even though we gapped higher on Monday, nothing else happened the rest of the week. So it was more of like a dead cat bounce feeling. And the weekly doesn't give you that much more reassurance either. It's almost telling you, okay, we rallied last week, we rallied this week, maybe the rally is going to be done here, maybe we have a little bit lower to go. That's why it's going to be very important for the S&P 500, for the Nasdaq to break above those Thursday highs and confirm that inverse head and shoulders pattern in the short term so that we can get back to the all-time highs again. Because the candle that was formed this past week on QQQ really is not that healthy of a candle. It shows that while there was some momentum early on in the week, it gave it all back by the week's end and really didn't finish that much higher. But one interesting side note, and this is more from experience than anything else, one of the things I have noticed over the years is that when you have a bottom that's potentially formed, that first week you're going to get a very solid rally, but the second week or even the second day of a rally, it depends on the time frame that you're looking at, it usually struggles. That second candle will oftentimes show signs of weakness, and then all of a sudden the third week will just explode higher. So there's the potential that we're seeing that here. You saw earlier this year on the Qs, we put in the bottom, and then that second week we struggled to make any gains. In fact, it finished red before exploding higher on the third and fourth week. So while I'm throwing a little bit of caution out there, I don't think that you have to go sell everything. I think there's still the potential the market will rally next week, especially if President Trump shows signs of recovering from the COVID virus. Now, the Qs on the monthly chart, yeah, it's showing pullback for the second straight month. There's a lot of support at the 20-month moving average. The problem is there's a lot of room to fall before that gets tested. In fact, it could wipe out 3 months of gains before it ever tested it. If you look at it from a historical setting, the market has oftentimes pulled back to these key levels and found support there. And even when it's riding higher, it'll often ride that 20-day moving average to new all-time highs. Now, the Russell Index, IWM, was by far the strongest of the indices last week, mainly because it managed to rally on Friday while the S&P 500 and the Nasdaq could not. And it's rallied 6 out of the last 7 days, and the only index last week to rally 4 out of 5 days. However, if you've been watching these videos for any length of time, you know that there's a huge resistance level overhead, and I'm going to highlight that again on the weekly chart as well, because there may be even a trade setup opportunity that arises out of it. It's much improved over the last 7 trading days, but there's still some room to go before I can get totally confident with adding some new small cap positions to my portfolio. On the weekly chart, you have a declining trend line off of the 2020 highs that if it can break that, then there's a good reason to go ahead and get long on this index, but it may be short-lived as there's a even far bigger resistance level going back to 2018 that could stall it out before it has a legitimate chance at testing new all-time highs. And of course, on the monthly chart, it still looks a little bit of a heaping mess here. Yes, it's a huge rally off of the March lows, but it's in this choppy mess right now on the monthly chart that it's struggled over the years to get through. But unlike all the other indices, it's still up on the month of October, albeit very early in the month. Nonetheless, it is diverging from the rest of the market at this moment. And this past week, I actually scaled back a little bit on my long exposure. I added some positions earlier in the week. I took some profits along the way. But then I started scaling back a little bit on Friday. I took a higher risk position off the table just because I didn't want to hold it over the weekend. I don't know what the headlines were going to look like come Monday morning with President Trump's conditions. So it was best to take some of the higher risk trades off, because if things really went south, some of those higher risk trades with higher betas could be down as much as 10 or 20% come Monday. And I don't want that if suddenly we were dealing with something very difficult. And to be honest, I would say 99.9% of you guys listening to this video have not experienced anything like this. I haven't, because the last time we saw a president dealing with a major health issue was probably the Reagan assassination back in the 80s. So this is like new territory for almost all of us. So I took a little bit of risk off the table. I wanted to play it safe. And if Monday morning comes and the market wants to rally, I'll probably add some more positions to the portfolio. You have plenty of headline risk out there. You're seeing the market react not only to the Trump COVID situation, but to COVID stats starting to spike again in New York. And you also have a lot of stimulus headlines that are starting to resurface in the market this past week. So all of them could be for better or for worse, but our job as traders is to react to them accordingly. So when they do happen, we trade based off of what we're seeing, not what we think is going to happen, but what we see happening. If you like this video, I encourage you to smash that like button. I appreciate every one of you who continue to support this channel week after week and month after month. It means the world to me. I'm continuing to put 2 videos out there. I doubt there's anybody that's doing as much research on these markets on a daily basis that I do. I have to do these videos at night or on the weekend simply because during the day I'm always trading. I'm always watching the market. There's no time for this stuff. So make sure that you're also subscribed to this channel so that you can be notified every time I post a new video. If you have any questions, make sure to throw them down in the comments. I love reading them all. I try to answer every one of them. I really do. And let me know, how do you think the COVID-19 situation with our president is going to affect the markets in the week ahead? Thank you guys, and God bless.